What shaped markets today wasn't simply that stocks moved higher, it was a noticeable shift in how investors interpreted risk, inflation, and the durability of the AI growth story. Markets didn't rally on broad confidence, they rallied on selective confidence. The S&P 500 gained about 0.75%, the Nasdaq surged nearly 2%, but the Dow actually finished lower. That divergence matters. It tells us investors were not buying everything. They were targeting growth, technology, and long-duration assets that benefit when interest rates ease. At the same time, bond yields moved lower, oil prices fell nearly 2%, volatility declined, the dollar softened. Taken together, that created a much friendlier backdrop for risk assets, especially tech. So what changed? Part of today's move came from easing geopolitical tension tied to US-Iran developments, which helped reduce immediate fears around energy supply disruption. When oil falls, markets often read that as lower inflation pressure ahead. And when inflation fears cool, investors begin to believe central banks may not need to stay restrictive for as long. That helps explain why Treasury yields drifted lower. And once yields fall, the valuation pressure on growth stocks starts to ease quickly. But macro relief was only half the story. The second major driver came from earnings, especially in semiconductors. Intel posted strong results and upbeat guidance tied to AI demand. That helped ignite a broader rally across chip makers, with names like AMD, ARM, and NVIDIA also moving higher. Markets appeared to interpret this as something larger than one company beating estimates. They saw it as another sign that AI spending remains real, broad, and durable. That matters because much of the market's optimism still depends on the idea that corporate investment in AI infrastructure can continue supporting earnings growth. So how did money react? Institutional flows looked concentrated and offensive. Capital moved aggressively into technology. Consumer discretionary also gained. Meanwhile, healthcare, financials, industrials, and communication services lagged. That usually signals investors are willing to take risk, but only where earnings momentum and lower rates support the thesis. This was not a classic broad risk-on day. It was a targeted rotation into the areas with the clearest narrative support. And that brings us to the hidden fragility. Today's rally looked strong on the surface, but market leadership remains narrow. When a handful of megacap and semiconductor names drive index performance, broader weakness can be masked. That creates dependence. If yields rise again, or if inflation data surprises higher next week, some of today's enthusiasm could be challenged quickly. There is also geopolitical complacency risk. Oil fell because markets priced in easing tension, but energy markets can reverse fast when they depend on headlines. And with valuations elevated, earnings expectations leave little room for disappointment. One open question investors are debating now is whether today's move reflects a healthy continuation of the bull trend or simply another short-term repricing driven by rates and positioning. I'd be curious how you see that balance. Feel free to share your view in the comments. So what is the broader macro signal? Today did not look like a new economic regime. It looked more like an expectations reset. Markets temporarily embraced four ideas. Lower yields are supportive, lower oil is disinflationary, AI earnings remain resilient, and Fed patience is still possible. That is a change in perception more than a confirmed change in fundamentals. Looking ahead, next week could test this narrative quickly. Investors will be watching the Federal Reserve meeting, GDP data, PCE inflation, and major tech earnings from companies like Microsoft, Amazon, Alphabet, Meta, and Apple. Those events will help determine whether growth can stay resilient without inflation reaccelerating. What this suggests for investors is that headline strength can sometimes hide narrow leadership and fragile assumptions. Today's rally was impressive, but the next move may depend less on momentum and more on whether incoming data validates the optimism. If you enjoy calm, analytical market briefings that focus on what actually drives price action, consider subscribing. I publish regular updates designed to help busy professionals understand markets more clearly. Thank you for spending a few minutes here today. I appreciate you being part of the channel.